U.S. economy is strong. Inflation is in the neighborhood of the 2% objective. The labor market continues to be surprisingly robust. The Fed is just going to keep moving more or less in line with the dots.
Right. So we had Mark Grant on in the 6 o'clock, was in the 6 o'clock hour, 7 o'clock hour, who basically made the case that he thinks that they might be moving too fast.
I think in this economy right now,
that things aren't as hot as they look.
The only hint of maybe some softening is in the housing market. And I would say maybe there is some signature of mortgage rates that are starting to cool the housing purchases a bit. But when you look at the consumer, when you look at the corporates, when you look at the fiscal stimulus that's coming online.
What if I told you that oil prices are going to are going to get to a point where that's actually going to become a drag as opposed to a boon?
So it's hard to work that through. I think over long horizons, higher oil prices are a net drag on the economy due to their impact on the consumer. But over short horizons, say the next year or so, that may very well be stimulus for unconventional oil and for investment in that sector.
Where's the 10-year yield in a year?
So on balance, I think right now there are more upside than downside forces on the 10-year. When I look at it, I see inflation gradually rising. I see a red-hot economy. I see the Federal Reserve hiking rates, and I see a lot of issuance coming online. So my guess would be somewhere in the 3.25 to 3.5 range.
We're at 3.25 now?
We've had a very rapid adjustment over the last few weeks, arguably more rapid than maybe is justified. But over time, I think that we'll see that. But over a longer horizon, I think there's a case that with high debt and demographic problems, that interest rates may be back down below 3%. That's our house call.